Hello everyone and welcome back to these sessions on CFR for CMA Final. In this class of CFR, we are going to get started with something called as reconstruction of companies. Reconstruction of companies. So, what I want you to understand, what is the meaning of reconstruction? That conceptual clarity is first of all needed. What is the meaning of reconstruction? Why a company requires a reconstruction? And how to do this reconstruction? What could be different types of reconstruction? Let's move step by step. The term reconstruction means something has gone wrong and that is why you want to reconstruct. Imagine if I have constructed a building and I say now I want to reconstruct. When will I reconstruct a building? Tell me. If I have created a building which is absolutely new and exactly as per the manner I want, do I break it down and reconstruct at that time? Or when there is a building which is quite old, which is now having, all the weak elements, the whole construction that was made, say 30 years ago, now the building structure has become weak. And then I feel that I have a need to reconstruct this building. So come on, give me your response. When should I reconstruct a building? Is it that when the building is in a proper condition or when the building has become weak? Come on, give me your responses in the chat box. When should I reconstruct that building? The obvious answer is when the structure of the building has become weak. That is the time you need to reconstruct it. The word construct and reconstruct. Why you would reconstruct something which is all fine? You don't want to reconstruct something which is already fine. Now we are talking about reconstruction of company. This does not mean like buildings physical reconstruction. It is reconstruction in your accounting records. So when can we say a company has become weak? When building becomes weak, it has a physical conveyance, means it has a physical symptom. You can identify that the structure has become weak. But a company becoming weak, what does that mean? It's basically the financial position of the company that has become weak. The company started with an objective of earning profit. But in reality, it could not earn profit and it has incurred losses. And the losses have got piled up. Year after year, losses. So use your simple common sense. When there is profit, it is going to build your capital. When there are losses, it is going to wipe off your capital. Correct? Can we agree? Losses will wipe off your capital. That is why, look at this alternative term used in the heading. It is capital reduction. It is capital reduction used over here. But now you will tell me that, sir, this capital reduction is given within brackets. The main heading is internal reconstruction. Sir, you did not say anything about external or internal reconstruction. No problem. I am coming to that. What is reconstruction? That is what we are focusing right now. Reconstruction means changing the financial position of the company. So before and after, it is after reconstruction when you are reviving the financial position of a company. Now let me introduce that reconstruction can be of two categories, external and internal. My focus point is never external reconstruction. My focus point is always going to be internal reconstruction. Sir, why you don't want to focus on external reconstruction? Because it is something that you have already learnt if you have learned the topic amalgamation absorption, you have already learned external reconstruction. How? What is external reconstruction? There is a company A which is facing bad financial position, extreme bad financial condition, company A. Now a new company was formed to take over the business of A Limited. Say a new company B Limited was formed to take over the business of A Limited. Company A is the selling company. It will record everything as you record for sale of business. Company B is the purchasing company. It will record everything as if you are taking over a business. End of the matter. Now you tell me, why should we discuss something that we have already learnt in the earlier discussions? It is internal reconstruction. It is internal reconstruction that drives my attention. Because in an internal reconstruction, an existing company which requires reconstruction of its financial position does not wind up and it is not taken over by another company. That takeover transaction does not happen when it is internal reconstruction. That means reconstruction happened internally. You people understanding me, right? Come on, at least by your expressions you can give me signal that yes, we are following. By your expressions also it is fine, because I can look at you. Most of you are visible over here in front of me. Yeah. So let us imagine that I am the equity shareholder of this company and you people are either debenture holders or loan providers or creditors. So let us say if I divide this role, for example, I'll take names of a few students so that you understand what exactly I am trying to convey. For example, in our class, say Srinath is the debenture holder, Ganesh is, say, a loan provider, a bank maybe, Shalini is a creditor, which is a secured kind of creditor, Kamaleka is, say, another creditor which is unsecured kind of creditor, and all of you have a big doubt, a big question mark that this company who has borrowed money from you is not in a position to give you back. Correct? This is your worry. This is your worry. Now amongst you, based on what role I have assigned to these 4 students, who will be least bothered? Who will be least worried? It is Srinath who will be least worried. Correct? Srinath will be least worried because Srinath is taking the role of a debenture holder. Debenture holders have a floating charge on the assets of the company. Basically, debenture as an instrument itself has a floating charge on the assets of the company. It means it is a secured kind of debt provider. Any secured kind of loan provider will not have a problem because they know that they have the security available with them. When the company is winding up, debenture holders having floating charge, when there is a winding up of the company, it cannot be done just like that. It will be with the permission of the court. And when the court has given approval, you will always observe that every part of the liability is to be settled. So when you are settling each and every liability, court will be asking all the debt providers that are you okay with the settlement? If parties have confirmed yes, no problem. If they say no, we are not okay with the settlement, then court will intervene and court will demand the liquidation to happen in a systematic manner in which everyone is paid their dues systematically. So when the assets of the company are sold, debenture holders have a floating charge on the assets of they will be paid first. Then there will be payments of other parties. So there is a proper hierarchy, a proper sequence, a proper order in which the parties will be settled. The unsecured creditors will be at the second last position, and I will be at the last position, the equity shareholder. Actually speaking, shareholders of the company also could be two categories: preference shareholder and equity shareholder. Common sense, who will be paid first between the two of them? Preference shareholder will be paid first, because right from the point when you have learned what is preference share capital, you know that preference shareholders will have preferred right over the equity shareholders to get back their capital on the winding up of the company. So the last one standing in the queue will be equity shareholder. So now, when a company is running into a bad financial condition, there can be only two possibilities: either reconstruct it or wind up. Now guys, I am asking you a question. Use your brain and tell me, which business can pay you back more, a closed business or a running business? Which business has more potential, a business which is shut down or a business which is running? Come on, let me see what comes from your common sense. Which business has potential of generating more payback? Obvious answer is a business which is running. When I say allow the company to be reconstructed, it will generate more potential. So suppose one of the party, like Ganesh in our example, who is a bank and a loan provider, partly secured, what will happen? He knows for sure that if the company goes for a wind up, he will be getting rupees 70 in place of rupees 100. But if the company continues, he may get 85 or 90. By choice, why someone will compromise for less when there is a chance to get more? So a proposal is laid down in front of everyone that, see, company's financial condition is bad. Each one of you contribute something. Each one of you contribute something. And when each one of you are contributing something, by leaving your claims, I repeat, by leaving your claims, by foregoing your claims, what will happen? Tell me, what will happen? In each one of you is leaving out certain part of the claim. It can be used as a benefit to wipe off the accumulated losses. The biggest contributory over there will be the equity shareholder, because equity shareholder anyway is not going to get anything if the company goes for a wind up in a bad financial condition. So each one will have to forego a substantial portion of their claim depending upon the hierarchy in which they were supposed to be paid. The secured loan providers and debenture holders will forego the lowest amount. The unsecured creditors and shareholders will have to forego maximum amount. Now let us use simple common sense to understand the accounting, and it is the common sense that will work over here. Fact number one: no accounting standards govern reconstruction. You following me? There are no accounting standards designed for reconstruction. So you have to pass accounting entries with your common sense. So let us say the total amount of debenture holders claim is 10 lakhs, and debenture holders have agreed for foregoing 10% of their dues or 10% of their claim. They have agreed to forego 10%. So please listen to me and understand. 10 lakhs is the amount towards debentures. They have agreed to forego 10% of that. 10% of 10 lakh is 1 lakh. Now use your common sense. Debenture holders, their credit balance lies in debentures account. that means in the company's accounting records, there will be a debentures account with a credit balance of 10 lakhs. Now I have to revive it to 9 lakhs. I have to reduce the credit balance from 10 lakhs to 9 lakhs. What will I do? To reduce the credit balance of an account, what do? I debit that account by 1 lakh. Correct? So I pass an entry, debentures account debit 1 lakh. 2. I will create a temporary account called reconstruction account. So I am creating a temporary account with the name reconstruction account. Everyone's claim foregone will be accumulated over there. Every component of losses will be passed on to that reconstruction account, and the balancing figure of that account, if it is any balancing figure arising as a surplus, it can be transferred to capital reserves. It can be transferred to capital reserves. Why capital reserves? Why not revenue reserves? Because events like reconstruction are rare events. They don't happen frequently. It's not that every year you plan a reconstruction. It's not going to happen. Once in a lifetime, a company may undergo a reconstruction, that too with the permission of the court. Without court's permission, you cannot go for reconstruction. Are you people getting my point? And I am talking about internal reconstruction, because the moment I put the discussion to external reconstruction, it is a company which is selling its business and another company which is buying its business. And I am not discussing that at all. My focus right now is just this part, internal reconstruction. So getting back to that explanation, the debenture holders have foregone their claim by rupees 1 lakh. What will be the journal entry that you will pass? You will pass a journal entry, debentures account debit to reconstruction account. Then bank loan has foregone its claim by 3 lakhs. So what accounting entry you will pass? Bank loan, again bank loan will have a credit balance, correct? So bank loan will be now debited by 3 lakhs. They have left their claim by 3 lakhs. So bank loan debit 3 lakhs to reconstruction account. Then outstanding interest on bank loan and outstanding interest on debentures, both were foregone. So outstanding interest on debentures was say 50,000. Outstanding interest on bank loan was 80,000. So outstanding interest debit by the aggregate of the two, because outstanding interest was liability. 50,000 plus 80,000, 1,30,000. So outstanding interest debit to reconstruction account. You are debiting all the liabilities, all the payables you are debiting, because by that amount you are going to reduce them. And you are giving the corresponding credit to that temporary created account, that is reconstruction account. Then you all will have even creditors. So creditors have foregone their claim by 5 lakhs. So I will pass yet another entry, creditors account debit to reconstruction account. Now people will question, all of you will question, that we all have left our claim. What about you? I am the equity shareholder of this company. I have to forego the maximum amount of claim. I say, okay, I was earlier claiming 25 lakhs. My total equity capital is 25 lakhs. I forego 80% of that. I forego 20 lakhs. I am now demanding only 5 lakhs. So I have foregone 20 lakhs. What will be the accounting entry that you will pass? Equity share capital debit to reconstruction account. That entry will be passed by 20 lakhs. Now you have accumulated sufficient credit balance in the reconstruction account. Now start charging all your losses. So all your losses have a debit balance, correct? All your accumulated losses will have debit balance. So how will you pass entries to knock it off? You will now debit the reconstruction account and credit all your losses. Understood, Ray? You will debit the reconstruction account and credit all your losses. So reconstruction account debit to accumulated loss. And then what you have to do is you have to finalize the reconstruction account. Is there any balancing figure left over there? Now this account which you have made as reconstruction account, it is a temporary account. You can name it by any name you want. There is no restriction on that. But obviously we don't name it anything. I cannot write an account as evergreen account, because what is happening, why we are preparing that account, that will be the suitable title, right? So the title is given either as reconstruction account or the title is given as capital reduction account. Either a reconstruction account or a capital reduction account. So you prepare, you pass all these entries, you prepare reconstruction account. In case there is a surplus arising in reconstruction account, that surplus will be transferred to capital reserve account. And finally, you will have to prepare the balance sheet after reconstruction. You will have to prepare the balance sheet after reconstruction. So you know, I am giving you an instruction. You follow that instruction. When you create balance sheet after reconstruction, you will write balance sheet of X Limited. Balance sheet of X Limited. And over there you will write and reduced. The words and reduced should be written, indicating that this is the balance sheet after reconstruction. This is the balance sheet after reconstruction. So the temporary account that I have mentioned could be named as reconstruction account or capital reduction account. There is no standard applicable on how to make this account or what should be the title of that account. What is compulsory is that the balance sheet that you make after reconstruction must have the brackets with the title, and within brackets you have to mention and reduced, which will indicate that this is the balance sheet after reconstruction. I believe by far whatever I have discussed, you people are clear with that. If you give me a confirmation so I can move ahead. Alright, so here first thing, the Act does not prescribe the manner in which reduction of capital is to be affected, nor there is any limitation on the power of the tribunal to confirm the reduction, except that it must be satisfied that every creditor of the company has either consented to the said reduction or they have been paid off, their interest has been secured. So what exactly we have discussed even earlier, that there is no restriction on how to do this, neither legally nor accounting wise. Court is mainly interested that okay, if you are going for reconstruction, each party's interest should be taken care of. Now, how to reduce the share capital? It can have three different ways. I'll explain it to you. Suppose there is a share of face value 100, but it is paid up rupees 75 only. So, 100 rupees face value share which is paid up only to the extent of 75, you need to reduce that. You can directly convert a 100 rupee face value share which is paid up rupees 75 by transforming it to a share with a face value of rupees 75. This could be one way. But in this case, shareholders are not contributing anything. Correct? Shareholders are not contributing anything. Another thing could be, suppose the shares are of rupees 100 each, fully paid up, and we cancel say 25 out of what they have already paid. So we are now considering that these are shares of 100 each, but only 75 paid up. Balance 25 the shareholders will have to contribute. This could be another way. Yet another way to reduce the capital could be by altering the number of shares. So for example, if I want to reduce the capital by 40%, each shareholder who is having 10 shares, I will ask them to surrender 4 shares. There can be different ways in which you can come up with reduction of the share capital. That has been explained over here in this part. And then what is given over here are steps. What are the steps to be carried out? I have already kind of explained to you the steps that are needed. When we are taking up the illustrations given in the book, you will be more clear with the steps. So initially when I was explaining to you, I have given you step-by-step procedure of how to move ahead with this. We will do one thing. We will directly begin with an illustration to have a much clearer understanding of the theory that we have done by far and the concept that we have covered by far. Couple of illustrations you do, that will be enough. So let us begin with the illustration that you are finding on screen, that is illustration 21. So let us read this illustration. Illustration 21 on internal reconstruction. The following is a balance sheet as at 31st March 2017 of Hopeful Limited. Look at the balance sheet carefully. Share capital 8,500 equity shares of 100 each fully paid up. So amount is 8,50,000. 4,000 cumulative preference shares of 100 each fully paid up, 4 lakhs. Securities premium 20,000. General reserve 60,000. Trade creditors 3,80,000. Then you have fixed assets including goodwill of 1 lakh. The total fixed asset value is 11,80,000. Investments 40,000. Stock in trade 2,75,000. Trade debtors 1,50,000. Bank balance 65,000. Now contingent liability, preference dividend in arrears rupees 60,000. The board of directors of the company decided upon the following scheme of reconstruction, which was duly approved by all the concerned and put into the effect from 1st April 2017. Now what was agreed? First point, the preference shares are to be converted into 12% unsecured debentures of rupees 100 each with regard to 70% of their dues, including arrears of dividend, and the balance equity shares of rupees 50 would be issued. The authorized capital of the company permitted the issue of additional shares. Second point says equity shares would be reduced to rupees 50 each paid up. Since goodwill has no value, the same is to be written off fully. The market value of investment is to be reflected at 60,000. If you can see what is the market value or what is the value of investment given in the balance sheet, it is 40,000. So actually in investment you are going to record a increase, correct, from 40,000 to 60,000. Obsolete items of stock 75,000 are to be written off. This will be basically reduction from your stock. Bad debts to the extent of 5% of total debtors would be provided for, means you create a provision for doubtful debts. Fixed assets to be written down by 1,80,000. The company carried on trading for 6 months up to 30th September and made a net profit of 1 lakh after writing off depreciation at 25% per annum on the revised value of fixed asset. The half yearly working resulted in increase in sundry debtors by 80,000, stock by 70,000 and cash by 50,000. You are required to show the journal. So you just have to show the journal. So let us deal with this one by one. First thing what you need to do, in your existing balance sheet, look at this. The cumulative preference share has a balance of 4 lakhs and the dividend in arrears is 60,000. Both of these to be identified first. So you have debited the cumulative preference share capital of 4 lakhs and the amount of unrecognized outstanding dividend has also been considered over here. So the total amount to be taken to the cumulative preference shareholders account is 4,60,000. Now 4 lakh was in the balance sheet, but now that you have agreed to pay 4,60,000, excess is 60,000. That excess of 60,000 is to be adjusted with the capital reduction account. As I said, You may write up reconstruction account or capital reduction account. That is not going to make any significant difference. Now, what has to be done in place of this? You are going to issue 12% unsecured debentures. Let us read that line. That line says, preference shares are to be converted into 12% unsecured debentures with respect to 70% of their dues. Now look at one thing. Their dues were 4,60,000. Please pick your calculator. Please pick your calculator and take 4,60,000 into 70%. It is 3,22,000. So 3,22,000 will be unsecured debentures, and then there will be equity share capital. The remainder amount will be settled by issuing equity shares. This is how you have settled the preference shares of your company. So please acknowledge and clarify one thing to me. 4 lakhs was recorded as the preference share capital amount. 60,000 was unrecorded arrears of preference dividend. Total due was 4,60,000. So because something was unrecorded, when you record it, it will be recorded as a loss, and that loss will be debited to the capital reduction account. Second thing, how will you settle that 4,60,000? 70% of that got settled through the issue of unsecured debentures, and the remainder 30% was settled by issuing new equity shares of rupees 50 each. So please confirm to me that up to this part, that means this portion of the journal that we have just discussed, are you clear with this much? Oh yes, based on some comments written by students that, sir, there is something wrong with this equity share capital amount. This cannot be 1,18,000, I believe. This cannot be 1,18,000. It has to be 1,38,000. So please rectify that. That was one error in your institute's material. It should be 1,38,000. Once that I have corrected that, please give me a confirmation that are you clear with this first initial part, this much. So the next thing that we have to discuss is about the equity shares capital reduction. Simple point is, equity share, the total amount was 8,50,000, comprising of 8,500 shares of 100 each. Now you are reducing it to shares of 50 each. So it will just get half. So 8,50,000 will reduce by 4,25,000. So look at the entry, equity share capital account debit to capital reduction account. And then you have to increase the value of investment by 20,000. You have to reduce the goodwill by 1 lakh. You have to reduce the stock by 75,000. You have to reduce the fixed asset by 1,80,000. And you have to create a provision for doubtful debt by 7,500. So all these amounts credited, and this increase in investment debited, the balancing figure will be placed as a net debit to capital reduction account. Now, after that, after all these entries, you can check what is the final amount accumulated in the capital reduction account. Pick your calculator, do as I am doing. First entry, this entry, you have debited capital reduction by 60,000. So 60,000 debit. Then this was the settlement entry. Capital reduction was not involved. Here you have credited capital reduction by 4,25,000. So I subtract 4,25,000. Now there is a negative balance. Then I have again debited the capital reduction account by 3,42,500. So I add 3,42,500. And the net credit balance that I am finding in the capital reduction account is 22,500. This indicates a surplus which we need to transfer to capital reserve. The transfer entry from capital reduction account to capital reserve account will be capital reduction account debit to capital reserve account 22,500, and your balance gets knocked off. That's all. Look at this balance sheet of Hopeful Limited. they did not write in the headings and reduced. I strongly recommend that you should write balance sheet of Hopeful Limited and reduced. So they have given some supportive notes, and with those supportive notes you should be able to understand the entire content of the balance sheet. So I am giving you some time. Please take some time and make sure that you have understood the whole balance sheet. In case you haven't, I will clarify whatever point you did not follow. But first you spend time in observing whether the content of this balance sheet is clear to you or not. Alright, now you would have gone through the whole content of the question, the solution, the balance sheet, everything, and you might be having some doubts maybe. So let us discuss one by one everything. So if you would look into the explanation given, first it begins with the equity share capital. Originally, look at the position of equity share capital in the question. It was 8,50,000 and it got reduced by 4,25,000, and then new capital issued was 1,38,000. Correct? So what should remain in the balance sheet? What should remain in the balance sheet is 8,50,000. You take half of that, that is 4,25,000 plus 1,38,000. That should match with the balance sheet figure of 5,63,000. So I am sure you understood this part. How we got 5,63,000 must be clear to all of you. This part. Correct? Now we are talking about other equity in note 2. Look at the content in the solution explanation. Securities premium was 20,000, it is still 20,000. There was a general reserve of 60,000, and what we transferred to capital reserve was 22,500. And now this is clear, right? We transferred to capital reserve from capital reduction account, and the profit that you have earned during the period. Now this is very, very important. Look at this, look at this. This balance sheet what was given to you originally, this balance sheet was on 31st March, from which date they started the reconstruction processing, and that reconstruction got completed by 30th September. So the balance sheet that you are preparing now is at a later stage, right? It is on 30th September. So during these 6 months time, you have earned some profit. Look at this. The profit that you have earned is 1 lakh given over here in the question. That 1 lakh is getting reflected in this working. Look at this. So if I try to reconcile, look at this. 20,000 was the balance in your securities premium. 22,500 is what we have transferred from capital reserve. I mean transferred to capital reserve from capital reduction account. Then the other amounts, the general reserve was 60,000 already. There is no confusion about this general reserve. This is definitely 60,000. This is 1 lakh which has got accumulated in profit and loss balance. So your overall balance in other equity would be 2,02,500, that has been mentioned over here, which matches with this particular amount, that is 2,02,500, which I believe now you should be clear with. The next thing in the note what is given to you is about property, plant and equipment. Let us look into one thing. What is the original balance of property, plant and equipment given to you? It was 11,80,000 of fixed assets including goodwill. Goodwill you have written off. So out of 11,80,000, 1 lakh gone. So 10,80,000 remains, and you have reduced your fixed assets by another 1,80,000. So what will remain is only 9 lakhs, correct? This 9 lakhs was the balance on that date. But then from 1st April to 30th September, there was a depreciation charged amounting to 1,12,500. What is the information given about depreciation? Let us read this. Depreciation was 25%, correct? So if you compute 9 lakhs into 25%, it comes to 2,25,000. Take half of that. Half of 2,25,000 will be 1,12,500, and that is the amount of depreciation, 1,12,500. So basically it goes this way. 9 lakhs was the balance of fixed assets after all the adjustments on 1st April, and then this was the amount of depreciation, 1,12,500, and 7,87,500 is therefore the amount of your property, plant and equipment after all adjustment and after charging depreciation. Look at that. It is matching with this amount, 7,87,500. This was given in your third working, correct? Third working. Any other working is it given to you? Now regarding your current assets, look at the position of your current assets. Let us reconcile that. You see, stock in trade, originally stock in trade was 2,75,000. 75,000 you have written off, and 70,000 was arising as an increase, correct? Increase during the period. Look at this question part so that you should not be confused. Look at this questions part. Half yearly working revealed an increase in sundry debtors by 80,000 and stock by 70,000. So stock has indeed increased by 70,000. So we are going for the increase in stock by 70,000. So that is this 70,000. So 2,75,000 originally minus 75,000 of inventory write down, and then increase in the stock value during the 6 months period is 70,000. It totally comes to 2,70,000. Then the other points, your receivables. Look at your receivables balance in the balance sheet. Originally the receivables balance in the balance sheet, that is your trade debtors, it was 1,50,000, and your half yearly working is going to increase the debtors by 80,000. and then you have to create a provision for doubtful debts. So look at this. This comma hasn't been placed properly. This should be 2,30,000. The comma should be over here. The comma should be over here. 2,30,000. Okay, this is 2,30,000. Basically, it is 1,50,000 plus 80,000, and from that you are subtracting. 7,500. What you get finally over here is 2,22,500. So 2,22,500 is the amount of your debtors. 2,70,000 was the amount of your stock, and cash. If you see in the balance sheet, what was the cash given? 65,000 was the cash given, correct? And when 65,000 was the cash given, the increase in cash is by 50,000. So this will be definitely 1,15,000, and the aggregate comes to 6,07,500. So everything matched up. 6,07,500 is also getting reconciled over here. 6,07,500. When you are finding everything getting reconciled, look at other components of your balance sheet. In your balance sheet, you have investments amounting to 40,000. Check investments amounting to 40,000, which has increased by 20,000. Look at this profit that you have recognized on your investment, correct? This profit. So investments got increased by 20,000. The final balance of your investment will be 60,000. That has been stated in the balance sheet under other non-current assets. That is your investment, 60,000. So I'll take this as well. So everything is matching up. If you can see in your balance sheet, your all assets total up to 14,55,000, and your equity and liabilities. So your unsecured debenture amount and your non-current liabilities are summing up to 3,20,000, 3,22,000 and 3,67,500. What is that? The current liability part is 3,67,500. Now basically your non-current liability is unsecured debenture amounting to 3,22,000, which I'm sure you would have understood, right? Look at the balance sheet. The balance sheet did not have any debentures as such. You have issued unsecured debentures to your preference shareholders, that is 3,22,000. That same 3,22,000 is appearing over here. So the only thing that now brings your focus is this amount, 3,67,500. What was the current liability balance given in the balance sheet? It was trade creditor, that is 3,80,000, and now it is stated in the balance sheet as 3,67,500. They have not given any explanation also on that. So you might be definitely wondering, from where did you get this balance? I'll help you understand that definitely. Please pay attention to this point. Look at one thing. What is given in this line? You have made a profit of 1 lakh. Your debtors increased by 80,000. Your stock increased by 70,000. And your cash increased by 50,000. So debtors, cash and stock, all these three got increased by 80,000, 70,000, 50,000. If you sum it up, it is coming to how much? It is coming to 2 lakhs, correct? So 2 lakhs is the total increase in your asset, supported by 1 lakh of net increase in the profit. Now, from where you got this accumulated balance of current liability as 3,67,500? So based on all the details available with us, we have reconciled everything, and as of now what I can see is, even in the balance sheet, if you consider current liability as a kind of balancing figure, it will match, though there should be a proper reconciliation. There should be a proper reconciliation which can be made only when you prepare a cash flow statement, which is not there available with us. Understand one thing, in the balance sheet we don't have any cash flow information readily available. So if you make a proper complete cash flow, because your cash balance, how much it was at the end, that is given to you. If you try to prepare a cash flow statement to reconcile, the only scope of that adjustment what is in the balancing figure will come to the current liabilities, because all other points are adjusted. So through cash flow statement, if you try to make it, eventually it will be coming as a balancing figure within cash flow statement. Instead of that, you can declare in the balance sheet itself that it is a balancing figure. So you can come to the balance sheet and put this as balancing figure. The current liabilities over here, you can put this as balancing figure. And your task is done. Your task is done. In your institute's material, this is the only illustration given on internal reconstruction. Now, people might be wondering that, sir, there's a big content given later, but these case studies what they have given are not case studies on internal reconstruction. These are all case studies given on amalgamation and absorption. It is all about takeover entries. They have given all these case studies throughout, some 6 case studies given to you. These are basically questions and solutions in different scenarios, and that's it. So with respect to purely internal reconstruction that we were discussing, there is only one illustration available over here, which I believe will be enough for you, because in current accounting norms there is no standard on internal or external reconstruction. So internal reconstruction, how it should be done, I have given you a brief explanation along with the solution of this illustration given in your material. There is nothing much that you need to do beyond this, and that puts an end to this whole discussion on internal reconstruction.